Hello class, this is the lecture recording for Corporate Finance Accounting 350. We're going to take a look at Chapter 9, Capital Budgeting Techniques. So to begin, let's take a look at the learning outcomes. So at the end of this chapter, these are things you should be able to know and do. Describe the importance of capital budgeting decisions and the general process that is followed when making decisions about investing in fixed, which are capital assets. 2. Describe how the net present value NPV technique and the internal rate of return IRR technique are used to make investment or capital budgeting decisions. 3. Compare the net present value technique with the IRR technique and discuss why the two techniques might not always lead to the same investment decisions. 4. Describe how conflicts that might arise when using the NPV and IRR techniques can be resolved using the modified internal rate of return MIRR technique. And 5. Describe other capital budgeting techniques used by businesses to make investment decisions and which techniques are used most often in practice. So, what is capital budgeting? The process of planning and evaluating expenditures on assets whose cash flows are expected to extend beyond 1 year. Okay, so this is what usually happens within companies. I know at NAPI we usually take a look at our capital budgets, and that's kind of what guides a lot of the work that we do and new investments and new opportunities when we look at it down the road. So analysis of potential additions to fixed assets, long-term decisions generally involve large expenditures. Very important to firms' future. Okay, so generating ideas for capital projects, both a firm's growth and its ability to remain competitive, depend on a constant flow of ideas for new products, ways to make existing products better, and ways to produce output at a lower cost. Procedures must be established for evaluating the worth of such projects. Project classifications, replacement decisions, whether to purchase capital assets to take the place of existing assets, primarily to maintain existing operations. Expansion decisions, whether to purchase additional capital projects to increase existing operations, growth of the firm. A few years ago, actually about 3 or 4 years ago at NAPI, we took a look at getting into organic products, growing organic products. So there was a lot of capital budgeting that we were looking at how much potential income we could make, looking at net present value and some of those different rates when we were calculating what might happen and looking at optimistic values versus on the low end of realistic numbers. Okay, so those are things to take into account. Independent projects whose cash flows are not affected by decisions made about other projects. Mutually exclusive projects, a set of projects where the acceptance of one project means the others cannot be accepted. The Post-Audit compares actual results with those predicted by the project sponsors and explains why any differences occurred. Two main purposes: to improve the forecasts and to improve operations. Similarities between capital budgeting and asset valuation. 1. Estimate the cash flows expected from the project. 2. Evaluate the riskiness of cash flows. Compute the present value of the expected cash flows to obtain an estimate of the asset's value to the firm. 4. Compare the present value, PV, of the future expected cash flows, CF, with the initial investment. If PV of CF, our present value of cash flows, is greater than initial investment, purchase the asset. So whenever you take that into account, like I was saying with organics, our present value and expected cash flows was greater than our initial investment, so then we moved ahead. However, if it was going to be lower, then we wouldn't have done it. But the forecasts all look positive. However, as we've proceeded into year 3 of that program, the cash flows has not been as good as we expected, so we've actually backed off some of the organics, and we still grow organics, but then we are looking at, or not looking at, but we are still growing organic products that where our profit margins are good and they're high. So net present value, some of the present values of inflows and outflows. So here's the formula. Again, we've seen this formula throughout this course. It's a summation of all of the cash flows divided by our interest rate whenever we look at it to time. So that's all this is saying: year 1, year 2, year 3, all the way up to the nth term. Okay, that's all that is saying. Net present value decision rule: if a project is acceptable if the net present value is greater than 0. Okay. Net cash flows for project S and project L. So here's what it would look like in year 0. We have 3,000, 3,000. These are our cash flows in the future that we start to look at. So this is, honestly, whenever I look at S, that's a little bit worrisome because it started out good and then it decreased. And then on project L, honestly, I look at that and I see project L would be better. I mean, all that happened was the numbers were flipped, but the thing is, you know, looking at them over a 5-year, you never want to see a decrease. At least I don't. But in project L, you see that steady increase. So there are increasing and we're growing. That's kind of what you would want and expect to see whenever you're looking at a project. Cash flows timeline for project S and L. So you can take a look at this. This is just laying it out from initial investment to year 4, and then for both S and L. Okay. What is project S's net present value? Okay, so when we calculate this, actually we've actually done some of this in previous chapters. We're actually looking at these numbers with regards to projects, and if we should do a project, if we should fund a project, or if we should not. Okay, so project S is acceptable because its net present value is positive. Rationale for the NPV method. Okay, NPV equals present value future cash flows minus costs, so then net gain in wealth, which equals net gain in wealth or value. Accept project if net present value is greater than 0. Choose between mutually exclusive projects on basis of higher net present value. Which adds most value? That's the big question whenever we're looking at options. So we're looking at options here. Using net present value method, which project or projects should be accepted? NPV of S equals 161.33, 161.33, and net present value of L, 108.67. So if project S and R are mutually exclusive, accept project S because NPV of S is greater than NPV of L. If project S and L are independent, accept both because they both have net present values greater than 0. Internal rate of return, IRR, is the rate of return that will be earned if a project is purchased and held for its entire life. IRR decision rule: a project is acceptable if IRR is greater than the firm's required rate of return, R. So calculating the internal rate of return, IRR, again, this is very similar to what we've seen before when we take a look at future cash flows. Okay, again, I'm sure there's going to be a formula here in a bit where it says sum of this, because whenever you look at that sum, that equation lets you know that it's going to be elongated over time. Okay, a project is acceptable if IRR is greater than R, which is our rate of return. Calculating the IRR for project S. So here we go: 3,000, 1,500, 1,200, 800, 300. So as our net present value equals 0. Okay, calculating the IRR for project S. So 3,000 plus 1,500. This is year 1, year 2, year 3, year 4, and that equals 0. Financial calculator method: enter the cash flow sequentially into the cash flow register and then press the IRR button. So for project S, IRS equals 13.1%. For project L, IRR of L equals 11.4%. Rationale for the IRR method: if project's rate of return, IRR, is greater than firm's required rate of return, R, then some return is left over to boost stockholders' return. So example, IRR is 13%, greater than R, which equals 10%, so it's going to be profitable. So there's going to be a difference of 3% there. Decision on project S and L per IRR. If project S and project L are independent, that means they don't depend on each other, okay, except both. And it's interesting though, a lot of this finance stuff, there's a lot of connections to college algebra. However, if you do get into having a degree in finance, you're going to be working with some equations where that will require you to have taken calculus, because some of those equations are more complex. So to understand that, you'll need a class in calculus. But again, that's probably a class you've already taken. I know for accounting, I had to take calculus 1 and 2, but some schools are different. Okay, so just keep that in mind. I would check with your advisor on that. So IRR S equals 13.1% greater than IRR of L 11.4. So R equals 10% if project S and L are mutually exclusive based on IRR. Project S is more acceptable because IRRS is greater than IRR of L. Net present value profiles for project S and project L. So here they are, 800, 454, so on and so forth, and then here it is for L. Okay, so take a look at those. Discount rate over on the left-hand side there. So net present value profiles for project S and L. Okay, as you can tell, here's a crossover rate which equals 8.1%, and then this is what I'm talking about some having a background in college algebra and algebra, because these rates of return, obviously it's y equals mx plus b. So that's the rate right there. Okay, that's our slope in essence, and this is our y-intercept if you really think about it. Okay, because these definitely are straight lines. 2 reasons net present value profiles cross: size or scale differences. Small project frees up funds at t equals 0 for investments. The higher the opportune cost, the more valuable these funds. Thus, high R favors small projects. Timing differences: project with faster payback provides more CF cash flows in early years for reinvestment. Reinvestment rate assumption: net present value assumes reinvestment at R. IRR assumes reinvestment at IRR. I know that's confusing, but reinvest at opportunity cost. R is more realistic, so net present value method is better. Net present value should be used to choose between mutually exclusive projects. Ensures value is maximized. Multiple IRRs. Suppose a project exists with the following cash flow pattern. Year 1, 1.6 million, or year 0, that's our investment. Year 1, 10 million. Year 2, negative 10 million. 2 IRRs exist for this project. So net present value profile for project M. Here's our IRR rate, IRR of 1, 25%. Then it starts to decrease, so 400% required rate of return. Net present value equals negative 1.6 plus this was our $10 divided by our interest rate, and then a negative $10, which was indicated right here. That's why it says we made and then we lost. Okay. Modified internal rate of return, a better indicator of relative profitability, better for use in capital budgeting. Present value of cash flows, T of V divided by 1 plus modified internal rate of return to the nth power. So here's our summation formula again, coefficient of T, and our interest rate, our growth rate. Actually, that's growth rate. So then we're going to take this and then divide by our MIRR. Okay, this formula we've seen before, so we should know how to calculate that. MIRR rule: a project is acceptable if MIRR is greater than our rate of return. Okay. Traditional payback period: the length of time it takes to recover the original cost of an investment from its expected cash flows. Payback period: the year just prior to the year of full recovery of initial investment. Amount of the initial investment that is unrecovered at the start of the recovery year, divided by total cash flow generated during the recovery year. Traditional payback, okay, PB decision rule: a project is acceptable if PB is less than in asterisk equals years determined by the firm. So here's the payback period for project S. So taking a look at that, your 0, 1, 2, 3, and 4. So payback equals 2 plus 300 divided by 800, which is 2.4 years. Discount payback period, TBB, the traditional payback period, does not consider the time value of money. The discount payback period does. So the discount DPB equals the length of time it takes for a project discounted or present value of cash flows to repay the cost of the initial investment. DPB decision rule: a project is acceptable if DPB is less than the project's useful life. Okay, so it has to be lower than it. So here's discounted payback for project S. Okay, here's our discounted cash flows, and here's our cumulative discounted cash flows. Okay, remember how it said if it's less. Okay, so again, our DPBS is less than 4 years, thus the project is acceptable. Okay, notice on here 3.2 is less than 4 years, so that's why we're good with that. Budgeting, capital budgeting methods used in practice. Companies use more sophisticated capital budget techniques today than in the past 20 to 30 years. Companies use multiple capital budgeting techniques when making investment decisions. Okay, so keep that in mind. Look at what, it depends on the company you're going to work with or work for. But just keep in mind what they do. It's always good to ask what method they use. So I hope you are all doing okay. If you all have any questions, please feel free to email. I know I did open up any homework that wasn't completed in the past, but again, if you have questions, don't be afraid to ask. I know I submitted midterm grades prior to spring break, and I believe if I recall correctly, the mean or the average of the scores for this class was an 84%. Now, that actually went up because I did have some students submit homework after I had submitted midterm exam or midterm grades. So keep that in mind. If you have questions, again, email me. Thank you.